7 steps to lower your taxes. We've all heard that death and taxes are inevitable. Well, death may be inevitable, but taxes are not. With some tax planning, you can owe less money to the IRS at the end of the year. Here's a quick look at 7 steps you can take to reduce your taxable income and the taxes you will owe. These are basic tax saving strategies that every taxpayer should know. They don't involve offshore bank accounts or convoluted tax shelters. These tax planning devices are easy to understand and put to use, and are most likely to save you, the average taxpayer, money. Step 1. Earn tax-free income. Certain types of income aren't subject to income tax at all. The single best way to avoid taxes is to earn as much tax-free income as possible. There are many ways to do this. Some of the most common are selling your home, the home sale tax exclusion, saving money for your children's education, investing in municipal bonds, contributing to a health savings account, receiving health insurance and certain other employee benefits from your employer, and giving some investments to your children. Step 2. Take advantage of tax credits. Obtaining a tax credit is the next best thing to paying no taxes at all because it reduces your taxes dollar for dollar, something a deduction does not do. Congress has taken a great liking to tax credits in recent years and is adding new credits all the time. Some examples include tax credits for buying a hybrid car or making certain home energy improvements, such as adding a solar electricity panels or a solar water heater to your home. There are also child and child care tax credits and education tax credits. Step 3. Defer taxes. You'll have to pay income tax on your taxable income sooner or later, but you'll usually be better off if you make it later. Deferring payment of taxes to a future year is like getting a free loan from the government. There are many ways to do this, from postponing an employer bonus to investing in IRAs and other retirement. Step 4. Maximize your tax deductions. Perhaps the most well-known way to reduce taxable income is to take tax deductions. The more deductions you have, the less tax you'll pay. People in business can deduct all their business expenses, such as inventory, office or home office, travel, operating costs, and so on. Most small businesses can also qualify for an up to 20% pass-through tax deduction established by the Tax Cuts and Jobs Act for 2018 through 2025. Every taxpayer is entitled to take a standard deduction or itemize their deductions. Itemized deductions are usually personal in nature and include things like your home mortgage interest, property taxes, charitable contributions, and state income tax. The Tax Cuts and Jobs Act roughly doubled the standard deduction starting in 2018. As a result, only higher income taxpayers with a lot of deductions will itemize. There are ways you can try to increase your personal itemized tax deductions so you exceed the standard deduction amount. Step 5. Reduce your tax rate. Federal income tax rates can vary dramatically, from as low as 0%, capital gains tax rate for people in the 10% and 12% tax brackets, to as high as 37%. You can benefit from the lowest rates available if you earn income from long-term investments like stocks, bonds, mutual funds, and real estate. The profits you earn from these investments are taxed at long-term capital gains rates, which are lower than federal income tax rates. The capital gains tax rate on long-term gains is 20% for higher income taxpayers, people at the top end of the 35% bracket or the 37% bracket. For anyone in the 22%, 24% or 32% tax brackets, the capital gains tax rate is 15%. The rate is 0 for people in the 10% and 12% tax brackets. An additional 3.8% Medicare tax must be paid on such income by singles with over $200,000 in income and marrieds filing jointly with over $250,000. In contrast, the average working stiff must pay income tax on salary or business income at ordinary income rates, which can be as high as 37%. Step 6. Shift income to others. If you're in a high tax bracket, you can save substantial taxes by shifting your income to someone in a lower tax bracket, for example, your children. This process is called income shifting or income splitting. The Tax Cuts and Jobs Act made changes to the kiddie tax that make income shifting to children easier than in the past. Step 7. Take advantage of your filing status. Few people give much thought to their tax filing status, but it can have a big effect on the taxes you pay. Which filing status you choose, and taxpayers often have a choice, will determine the tax bracket you fall in. Your filing status is also crucial for calculating your standard deduction. You owe it to yourself to learn these basics about tax planning and how they can help you. The sooner you start to take advantage of these tax-saving strategies, the better off you will be at tax time. Then you can rest assured that you are not one of the many people paying too much money to the IRS. Thank you for watching. Don't forget to like, subscribe and comment down below for more finance tips and advice.